Good afternoon, everyone. Welcome to the seventh talk in the Only One Theme Talk series, Wave 2. Today's topic is Only Investment Instruments for Startups by Shruti Devasthali. Let me briefly introduce Shruti before we begin the talk. Shruti is the head of funding and investment at Venture Center. She is a chartered accountant and a certified financial risk manager. Currently, she is operating seed fund activities for Venture Center and monitoring the investments in Venture Center's portfolio of companies. She is responsible for mentoring investee companies on corporate governance and monitoring their progress in the capacity of board observer. She is responsible for monitoring the fund disbursements under various grant programs run by Venture Center. She is the project manager for DST's Nidhi EIR program implemented by Venture Center through 30 plus TBIs. And during her previous work engagement, she has worked with CRISIL and Dun& Bradstreet Information Services in the areas of credit rating and financial analysis. With this very brief introduction, I welcome Shruti. Welcome, Shruti, to the session and hand it over to you.
Yeah, hi. Hello, everyone. Thanks, Kavita, for the introduction. And I'm going to take you all through this topic about investment instruments for startups. It's generally for the early stage startups. It's very important to what kind of instruments are available, because most of the times what happens is you go and pitch to the investor, and then the investor hands over some term sheet with you, and then you see what kind of instrument they are going to invest in. But it's very important to know what are the different types of instruments and what does it mean for your startup or for a founder. So just to start with, these are typical sources of funding for a startup. So there could be fellowships, and fellowships could be, I've just listed few sources of fellowships. These are just some examples of it. There could be more also available with different institutions. And there could be, then the next stage is usually fellowships are available at a very early stage. Then pre-POC funding. Pre-POC funding is the funding in the range of up to 10 lakhs or so, which is available for early stage innovators for working on their proof of concept. Once for moving forward, for demonstrating proof of concept in certain domains, it requires higher funding, or even for prototyping, it requires higher funding. So those kind of funding can be availed under various schemes like BIRAC, BIG, SPARSH, or CIPRI funding from BIRAC. There are certain seed funds which can also invest at a very early stage. There are some CSR grants available. There are some foreign funding sources are also available in terms of like grant challenges, or even some state government funding is available at this stage. To take it forward in terms of trials and advancements, most of the times the incubator seed funds are available to between 50 lakhs to 1 crore, or some angel investors can also fund at this level, or if there could be some higher amount of grants, or which are like BIRAC gives BIPP grant or ANIC grant. Those grants are available at this stage. And moving forward, it is for manufacturing, marketing, and sales. Most of the times, the funding that is available at this stage can be a debt funding or venture capital funding. A proper VC fund may invest in a startup. So these are different types of funding available. But now, if we take an example of, say, seed fund, say any seed fund that an incubator is running. So, for example, Venture Center, when we invest in a seed fund, we invest in equity of a startup. There could be some incubators who may extend the same funding in the form of CCPS, which is a compulsorily convertible preference share. We will talk about it later. So, and there is one seed fund, which is the Startup India Seed Fund, which comes in the form of grant or in the form of debt as well. So, you need to understand what it means for your startup and what impact it has on your startup. So, just to before that, I would also like to familiarize you with what these funding stages, what are these different types of funding, how do they stand when in the hierarchy of repayment. So, if a startup is having all these funding from all these sources, not a startup, if a company is having funding from all these sources, then what it means, it's like if at all that company decides to close its operation or go in liquidation, or if at all they are not they want to say sell it off all the operations to another strategic partner and they want to just liquidate everything, in that case the sundry creditors are having the first priority to get money for their dues which are payable from the startup. So sundry creditors or creditors which are due for any expenses like salaries or any services that they have provided to the startup. So they have the first right of receiving money from the startup. Second is the secured debt. So secured debt can be secured loan can be in different forms. So it can be it can be like a bank loan, or it can be from any institution, or it can be debentures or so. But if it is a secured loan, then they have the first right to get money out. Unsecured debt is the third priority. After that, it is the shareholders. Within shareholders also, preference shareholders have the first priority and the equity shareholders have the second priority. Amongst equity shareholder as well, most of the times the investors, even if they are holding equity shares, they will always put some clause in their investment agreement that if, in case of a liquidation, they will have a priority over the founders. So most of the times, founders will be at last in terms of getting their money out of the company. So as you see, the priority is in this order. Similar, that means the risk of getting money out is higher as you move forward. So for creditors, they will definitely get money out if the startup has funds left. So that's the reason the return expected are also higher as you move forward. Like secured debt in rate of interest will be lower than unsecured debt. Similarly, the return that the preference shareholders will expect will be more than the unsecured debt or secured debt holders, because the debt holders mean the people who have given loan to the startup. They will agree for an interest rate. Preference shareholders will also agree for a rate, but that will be higher than the debt. Whereas equity shareholders are the holders who are taking the maximum risk in the startup, so they will expect returns which are much higher than the other funders to the startup. So that is how it works. Now, going forward, if we look at the instruments which are generally used for the seed funding, here I have listed what all are the instruments, some of the key features, and generally the monitoring mechanisms set up by the lenders or the funders. I will also show you one of such agreement, and we can actually have it more like an interactive session. I think we have it's a closed small group, so you can also put your questions as we finish one topic. Like right now, I am starting with grant agreement. If you have any questions on it, we can take it at the end of it. So in case of grant agreements, this is like at an early stage, most of the times when there is a risk is very high, when there is no certainty that the idea that you are proposing is definitely going to work, that is where the grant is the best option to fund your expenses. Because at that point of time, equity holders, most of the times they will not invest if there is no certainty, if there is no like proof of concept is not established, or if there is no any working prototype developed by the startup, the equity holders will not invest. Debt is out of question at this stage, because most of the times if you raise a loan, then you will have to start repayment of it also. So it should not be taken at an early stage. So grant is the best source of funding at this stage. So in this case, most of the times, what happens is like there will be a call for grants. So if you are familiar with different, BIRAC has various grants. or as venture center, we also open calls for say CSR grants. Then we receive applications under those calls, and those applications are evaluated, and the selected grantees we will sign a grant agreement with these grantees. So these grants can be of different types. Two types. One can be returnable grant. Another will be non-returnable grant. Non-returnable grant is the grant which is funded for a specific milestone. So all grants are actually specifically that is a project funding. It is, you have to define a project. You have to define the activities for which you need funding, and only those activities are funded. So when the grant budget is approved, you have to specifically give in terms of where you are going to fund, where you are going to spend this money. So you will have to do a proper diligence in terms of what are the activities you will carry on, what's going to be the duration of these activities, how you are going to source the say materials or manpower, or what kind of other activities you will have to do. Will you have to file a patent, or will you be outsourcing your work? Then what is going to be the charge for it? So you will have to collect all these information and then build your budget. So unless and until you prove what exactly you are going to do it, and if there are any if you have those quotations with you, then the grant budget gets approved. So once grant budget is approved, you will be signing a grant agreement with the grantor. So if it is a non-returnable grant, then you will have to just meet the milestones within the time frame that you have promised. And once the milestones are met, it's a successful completion of grant. In case of returnable grants, there will be a royalty component. So the grantor may be expecting some sort of return from if they are funding a very risky project. So they may ask you to give some royalty, and that the royalty terms will be mentioned in the royalty agreement. So in case once you sign a grant agreement, there will be a typical monitoring which will happen from the grantor's end. So that will be monitoring of the milestones from time to time. You might have set up the milestones every 4 months or every 6 months. There will be a detailed monitoring and evaluation whether you have actually achieved that milestone or not. Only when you prove that you have achieved the milestone, you will get funding for the next milestone. Because if you have not achieved the first milestone itself, then the further funding will not be extended. So that's why it is called a milestone-based disbursement of funds. Then the grants, even the grantor will track the progress of the grantees post grant period. That one of the things, that is because they want to monitor whether what has been the progress of the grantees, what has been, how the projects have proceeded further, whether you have been able to raise further funds, or what kind of traction you have raised after the grant is over. Then and that's why you will have to keep periodically updating the grantors, and that's a part of that's like an obligation that the grantee takes on when you sign a grant agreement. So even if your grant is over, you will have to still stay connected with the grantor and keep them updating about the progress. Now I will share one grant agreement. We will run through it, and then we can you can ask me few questions about it if you have. If you can open that folder. Grant agreement. Draft. Yeah. So I have just opened this draft grant agreement. So usually it will be between, here it was EDC, us, and say it can be with an individual or with a company. And all the terms of the grant are defined in this. There will be a space where the project will be specifically mentioned. So it is only for that project. So even if you have a company, you cannot spend this money for anything other than this project. There will be responsibilities of the grantee. ABC is a grantee here. So there will be responsibilities defined. So it's very important that you go through all these responsibilities very minutely and see that you stick to the timelines. Those are set for meeting those responsibilities. For example, if it is written then meet the resources on project activities to the extent as given in the annexure. So you go through the annexure and see what kind of project activities are defined. Usually, all these project activities, the milestones are defined in consultation with you. So you will have, when you are discussing this, you should have done good homework so that you don't over promise anything. You should know how much money you are getting in the first tranche, and you should promise the activities only which are manageable within that resource. At the end of every milestone, you have to submit a utilization certificate and a statement of accounts. So basically, utilization certificate, there is a format of it later in the agreement. I can take you through that. So it is to show that you have spent the money as per the agreement. Then there will be some commitments from the grantee's side. Also, there will be some warranties that you have actually you have disclosed everything and all that. So those will be there as a standard part of an agreement. I just want there will be one clause which will define the financial arrangements with the grantee. The breakup of the financial assistance will be given in Annexure 2, where like Annexure 2 might define exactly under each head of expense how much you can spend. So you will have to stick to that limit which is being defined under each head. There will be a project oversight committee to whom you will have to present your progress of milestones. Then the results of the project. So basically, it will always define what is expected out of the project. So that is the thing that will define whether the grant project has been successfully completed or whether if the project is closed or project is not successful, even if the money has been spent, but if you have not achieved the results which are desired, then it will be like unsuccessfully completed. So project duration is also defined. So anytime if you feel that there is going to be any extension or any more time that you are going to require for completing any project, you should ask for a extension well in time, not on the last day of the project. So all these things you should keep in mind when you are doing any project under grants, because most of the times the funder will always have to go back to the committee, take approvals from them for the extensions. If you go at the last moment, there is a chance that you may not get the extensions and you may lose out on the money. If you go well before time, if you give them time to do any changes in the terms, those are defined in this grant agreement, there is probably a chance that you will be able to get those changes done. So effective date and tenure of the agreement will be decided here, like from which date the grant agreement starts will be mentioned in the beginning of the agreement, that is called as effective date. Most of the times the expenses under grant will be allowed only from the date of the agreement. If you have spent something before that date, that will not be allowed, and it will be allowed only till the end date of the agreement. So if you have to spend anything, you have to spend it before the grant agreement ends. If you feel that you have not been able to spend money, then you have to ask for an extension, and only then, if it is approved, only then you should be spending on it. Then yeah, I'll just take you through quickly through the I'll take you through this. This is some annexures usually a grant agreement has. It's like details about the project. Then there will be an annexure which gives the details about budget. And also there will be an annexure which will give you a format of the utilization certificate. Every grantor will have a specific format in which you have to provide that budget utilization. So funds which you have received and how you have spent. You have to actually, sometimes it might be required that you have to give an audited utilization certificate. It is called a UC. It's a very commonly used word. So UC is utilization certificate and SE is a statement of expenditure. So most of the times it is required to be certified by a chartered accountant. So you will have to provide all the bills to the chartered accountant. They will certify it, and then you will have to provide it to the grantor. So something like this, there will be project heads and there will be a sanctioned amount for under each head. You will have to mention how much you have actually spent. So in case of grant, if you overspend, then also you will not get any money. And if you have underspent, then the money which was not spent will also not be given to you. So that's the reason it's very important that you stick to the sanctioned limits. If there is any change, talk to the grantor well in time. So milestone report, usually there will be a format for a milestone progress report that also you need to submit in a specific format. So this is about grant agreement. Do you have any questions on this? Then I can answer those, or we can move to the next instrument. We can also take questions at the end, but I thought if there is anything. Yeah.
Hello?
Yes, ma'am. Are you able to hear me, ma'am?
Yeah, I can hear you.
Yes, ma'am, you just mentioned overspend and underspend. Both is not good for the grant utilization. So, ma'am, can you just give any example on that to better understand, like how to manage this?
See, it's always better that if at all you have a grant of, say, if you have a grant of say 10 lakhs, out of that 5 lakhs was meant for manpower and 5 lakhs was meant for outsourcing. So if you have overspent, say in one head, if you have spent say 6 lakhs under manpower, but you have spent less under the other head, that is say outsourcing, you have spent 4 under outsourcing. So instead of 5, you have spent 6 and 4. So that overspend under manpower will not be considered for funding. For that something is called as a budget reappropriation. So you have to go to the grantor and tell them that there has been change in my budget. You have to get that approved, and only after that you will be able to get that 10 lakh of funding. Otherwise, if you don't get that approval, then you will just get 5 lakh under manpower and 4 lakh under outsourcing, that is 9 lakh. So you will lose 1 lakh rupees if you don't get the budget reappropriated.
Okay, thank you, ma'am.
So I think right now, since there are no more questions, so we can move ahead to equity and equity linked instruments. So equity is it's of different types. So one is like plain equity shares, where the investor will take equity shares against the investment that they are doing. And preference shares is also a form of capital investment in the company. The only thing there is like they have a preference if at all there is any liquidation in the company. So the preference shares have a preference over the equity shares, but they don't have a preference over the loans. Loans will get paid before that. So in case of preference shares, there can be plain preference shares or there can be compulsorily convertible preference shares. These are very commonly used. CCPS is a very commonly used instrument by all the investors, so that they have a preference. At the same time, they also have a right to convert into equity shares whenever there is any liquidation. So safe instruments is another instrument which is called as simple agreement for future equity. In case of simple agreement for future equity, it is a term coined by Y Combinator in the US. So there it is more commonly used. In India, though there is a safe agreement, the instrument in which the company invests, the investor invests, is still CCPS, because there is no instrument legally as safe. It is just that future equity means in future you will take equity in the company. Right now you are not taking equity in the company. So right now the investor might be investing in preference shares, or they might be even investing in a debt into the company. So that is what, but it's very commonly used because it is used in US markets. The safe word is very commonly used in India, but it's actually a CCPS or CCD as such. Then in the convertible instruments, the conversion is linked to the next valuation. So main difference between say equity shares, immediately taking equity shares or taking a convertible preference share, is that the conversion happens at a later stage. Right now, this is very startup friendly because sometimes the valuation of the startup is not possible at an early stage. because of various factors. So the startup may want to get investments against convertible instrument and then convert it into equity at a later stage when they actually prove that what they are saying is possible and they are in a better place to at a better stage to define the valuation and give the equity shares accordingly. So I have one Excel sheet which I will show you in terms of how it works quickly, so that maybe I'll just explain how what is the monetary mechanism and then we can move there. So I'll just explain that.
Yes.
So in case of equity and equity linked instrument, usually the investor will have a board observer or in nominee position and nominee position on the board of the investee. The investor will attend the AGMs, shareholder responsibilities, regular updates from the investees will be required to be given as per the agreement. So maybe we can open the, first we'll open the draft investment agreement. So usually the draft investment agreement is a very, you only when investment agreement. That PDF. Yeah. So usually whenever the startups receive the investment agreement, they get overwhelmed because this will be this first time when you see it, it's the first first agreement, financial investment agreement that you receive, and there are many clauses which most of the times startups find it very, for startup founders find it very difficult to understand. So it's very important that you know the key clauses. I cannot go through the clauses today because it's a big time consuming thing. But you can actually go through certain high level clauses, and I'm just showing it to you so that this is how it looks. It's usually about 45 to 50 pages document. It defines the rights of the investor, the rights of the startups, and what are the obligations of the startups. It also shows what is going to be the equity shareholding of the startup and before the investment and after the investment. So it also defines, I will just show you one few key clauses, how it looks like. So there will be certain conditions precedent, which means what all you need to do before you receive money. There will be certain things like what all you need to do after closing, means when you are receiving money, what all you need to do. Also, it has conditions subsequent, which means after you receive money, what all things you have to follow. These things are usually that issuing shares to the investor, then you will have to appoint the investor on their board, etc. So all these things will be defined here. So it's very important to take the help of a proper professional to deal with investment agreements rather than missing any of the clauses that you are signing upon. So even before signing, it's always important that when you are in discussion with the investor, you should not commit that you are okay with the terms. It's always better that you take advice from somebody, and every private limited company has its board. So you can always say that you have to discuss it with your board, you have to discuss it with your advisors, and take time for going through these agreements and then commit into it. So there will be some clauses, like I'll just show you, there will be some restrictions on transfer of shares by the founders. So and there are certain things, some clauses called exit clauses. These exit clauses are actually the clauses which define how the investor will be exit option for the investor. So how the investor will be getting exit from this from the startup. So there will be, you have to read through it very carefully in terms of what exactly the investor has written and understand it, and only after that you have to sign it. So I'll just show you through the Excel sheet in terms of, can we share the Excel sheet now? I think. So this is how usually, in case of a startup, see, if there is a founder A and there is a founder B, and if they are holding say 50% each, And if there is an equity investor who is coming into the company, says he is investing say 10 lakhs. And if you already had I'll just show you this one. So in founder A and founder B, you have 50-50% shareholding, and there is a equity shareholder coming with 50 lakhs of investment. The valuation, whenever there is an equity investment, valuation has to be defined. So if I'm investing at say 4.5 crores, then what it means is that I'm going to take 10% of your company. So you have to, this chart, how to prepare is another session, but how it looks like is like the two founders will be 50-50% before this investment, but after the investment, they both will be holding 45% and the investor will be holding 10%. So whenever you are actually talking to the equity investors, you have to see what is going to be your future cap table, how how your shareholding is going to get affected. So I'm not taking it into any complications as of now, because initially what's important is you understand what it means. And then if you really have any term sheet or so, we can discuss those separately whenever you come across that. But this is how it looks like, and this is what you have to look at in term by putting the numbers into an Excel sheet and seeing what impact it has on your startups. Just looking back, just by description, it does not actually give the real feel of what impact the investment will have on your cap table. The one thing is impact on the cap table, and the other thing is the rights that you are giving to the investor. Whether the investor is going to control significantly the company, that is what you have to look at. Yeah.
There is a question.
Difference in grantee net definition and only grant definition. So it's actually one or the same. So there is no difference as such. So next, the other instruments are debt agreements. Usually, debt comes in picture only when the sales are when the sales are. I mean, it's possible to project what kind of sales you are going to make when you have started making sales, and you can project how it's going to grow. That is the stage at which debt agreements are useful, because debt agreements come with an obligation where you have to immediately start paying it. There are some startup friendly debt schemes where you can actually, you may get some say 6 to 12 months of moratorium period, it is called. That means you don't have to make any repayment of the debt during that period, but after 12 months, you will have to start paying. So usually these kind of debts are done at an initial stage when you have a purchase order. You need some funding for actually manufacturing the products, and then you will start selling. When you start generating the revenue, you will start repaying these debts. So that is the stage where those kind of debts are considered. Yeah, so there is one debt agreement. We can quickly go through that. Loan agreement for small loans. That last one. Yeah. So these are also, yeah. So this is like a loan agreement for small debts. So this will also have, that will be an agreement with the borrower and the company who is borrowing. And I'll just take you to the last table, which actually shows what all things are included in this. So here, so what it actually defines what all are the conditions of debt. So that means it includes the facility, means what is the loan facility extended by the borrower. So how much is the amount? Then they will also mention how much you can initially get and whether it will come in tranches. That is defined here. Also, what is the purpose for which this loan is being extended? What is the period for which this loan is given to you? The term for repayment is also mentioned in this. Interest on this loan is mentioned. Most of the times, if it is at a startup level, many times the interest rates are very high. Here it is like say 16.75%. When there is an unsecured loan, the loan rate is very high. If it is secured by any of your assets, then the loan rate will be lower. Then the interest payment dates are also, there will be a repayment schedule, like every quarter or every 6 months or annual. It depends on what you negotiate with the borrower, with the lender. Then how the interest will be computed, that's also mentioned, whether it's going to be quarterly calculation or yearly calculation, so that or whether it is based on, here it is mentioned like calculated on the basis of the actual number of days elapsed. So one quarter may have 90 days, another quarter may have 91 days. So based on the number of days, the interest might be computed. So it also defines if you default in making the interest payment, or if you default in making any installment repayment, then in that case, what's going to be the consequence? That's also mentioned in this. Most of the times for loan facilities, there is always a processing fee. So if you raise a loan of say 25 lakhs, then 2% or 1%, it depends on what you negotiate. There will be a processing fee that you have to pay to the lender. That's most of the times is a part of it. There could be some people, intermediaries, who may facilitate the loan for your startup. So you may have to pay some fees for them as well. So there will be due dates by when you have to make payment. This repayment charge. So basically, interest default is if you default in making interest payments. Repayment charge if you default in making installments, like the repayment of installment on time. Then this moratorium period, in this case, it's 3 months only. It can extend to 6 months, 12 months, depending on the negotiation by the founder with the lender. So if the loan is secured, then what is the security, that is also defined in the agreement. The security margin is usually when you have a secured loan, what is the value of that asset is considered as a security margin. So if it is 1 times, means if you have taken loan of 25 lakhs, you have to actually keep an asset of 25 lakhs as a security. So it will be defined here, like how much security they are expecting. There will be a guarantor, guarantee. So who is guaranteeing that this loan will be paid is also mentioned here. So this is a loan agreement. In this case, what you need to see is basically what is the interest rate asked for and what is the repayment schedule, and whether you will be able, whether the cash flows that you are generating, whether you will be able to meet those obligations. Because if you default on making any payment, the lender has a right to even force a liquidation of a company. So having loan at an early stage is a very, very no. In fact, if there is a loan in the company, then most of the times investors making equity investments also shy away from doing those investments, because once they put in funds into the company, and if there is any sort of default, their money can also get used for making repayment to these lenders. So they don't want, early stage investors do not want any kind of debt into the company. Then service contract agreements is kind of an outsourcing agreement only, where this is usually related with an incubator, because suppose, for example, as venture center, we may get a project and then we may enter into a service contract with an incubator to executing that project. So that can be an agreement. I don't have a format for that, but that can be one arrangement. So it could be something like, if a startup is working on any particular project, then that can be applied for funding through incubator, where the incubator gets funded and gets the funding, but the project is executed by the startup. Grants through CSR funding, it's same as grants, but it is through CSR funding, means the big corporates give CSR funding to the incubators or any other eligible entity, and then they give it as a grant. Most of the times, for startups to get a CSR grant, its incubator is the only channel, because only incubator can actually extend it as a grant to startups under their operations. So yeah, these are different types of instruments. So I just kept, if we have time, I'll just cover this. Yeah. So if these are the various types of instruments in which the startup may get funding. So I have just considered here what are the further actions, or what are the impacts or of if you raise 50 lakhs grant for 18 months period. At the end of 18 months, if you complete the grant with the milestones that you have promised, it will just be a successful grant closure, and that grant will close. That agreement will not be effective at the end of 18 months. In case of returnable grants, once you complete that 50 lakh, once you spend the 50 lakhs and work on the grant will close, but you will generally have a royalty agreement along with it, which will continue. So your grant agreement will not be effective, but your royalty agreement will be effective till the time you actually do the royalty repayments as expected by the grantor. In case of CSR funding, it's same as grant. So it's just like a grant agreement. In case of equity funding, there will be an investment agreement, and usually that investment agreement will be effective till the time you actually give an exit to the investor. You refund the money back to the investor. So most of the times what happens in case of equity investment is the startup raises equity investment. And if you need more funding, and if you are again raising equity investment from the next investor, you have to take a permission from the earlier investor for the terms that you are getting into with the next investor. Because the agreement which you will enter into with the next investor overrides the earlier agreement. So the first investor will always want to see what kind of agreement you are planning to sign with the next investor, whether their rights are protected or not. So those are the negotiations, the communication that a founder has to manage. So, and they cannot promise without taking approval from the earlier investor. In case of debt agreement, it is like you will enter into an agreement, and that agreement will be closed only when you complete the repayment of the debt. Till the time, you will have to keep paying interest rates regularly. Also, the loan repayment also regularly. Yes, that is it. I think. So that is it. So if you have any questions, we can discuss those. So actually, I had that in Excel sheet, how that convertible works.
Yeah. Can you unmute? Yeah.
Okay. Hello.
Yeah.
Hello. Am I audible, madam?
Yes.
Yeah. Madam, actually, I had this confusion regarding returnable grant and grant in aid. Are they same? So I couldn't catch that properly.
Yeah. So basically, grant in aid is plain grant. Returnable grant means it will not be mentioned as returnable grant. It will be given to you as a grant, but there will be one condition that whenever you start generating sales, you will have to give some percentage of it in form of royalty to the grantor. So, are you in which domain are you working?
So we were working on a computer vision area, ma'am. Like we wanted to use a particular use case wherein we wanted to use a computer vision to aid in a software making actually. So it's basically group building software we were building, and the authentication we were doing with the ID cards of any institution. So it was a random card reader assignment. Yeah. So we had tried for different grants, but we couldn't get it because there was no definition of AI policy during that period. And so we were rejected by a lot of agencies, and then we stopped and we converted our startup into a service-based startup. So we are currently surviving with the giving service to the as by giving backend as a service. So we build backend for the software product and give that as a service. So that's how we are keeping the company alive actually. Yeah. So
usually whenever there is any grant given by the grantors, there will be some themes that they want to fund. For example, in case of BIRAC, they want to actually promote the biotech startups. Or there are certain grants which are given by, say, Department of Science and Technology. In those cases, they want to actually fund some innovative startups. So they will be looking for some kind of innovation or some kind of area in which they want to fund. So if you meet those requirements, only then you will get considered for grant funding under that scheme. So
Okay.
grants will always come with some specifications in terms of it is applicable to whom, and only those startups will be funded through that
Okay,
grant.
ma'am. Okay, ma'am. This EIR also I have applied for the same project, and it was to be. I got this call saying that in December it will be decided. So, do you have any idea regarding that, ma'am?
No, actually, in this month probably, yeah, we will be completing the process. Yeah.
Okay. Okay. Thank you.
I think Bhagyashree had a question. Do you want to take it up? Bhagyashree?
Yes, ma'am. Ma'am, that CCPS, you said you will talk about it. So I just wanted to know what the system is.
Yeah, so CCPS or CCD, these both are like compulsorily convertible instruments. So CCPS is a compulsorily convertible preference share, and CCD is compulsorily convertible debt, or it can be debt can be a debenture also. So it can be a compulsory convertible debenture. So what it means is right now, when if I'm investing into a startup at a very early stage, we might just agree on some valuation which is agreeable to the startup as well as the investor. But the startup founder always feels that I will be able to reach to the market faster, whereas the investor looks at it as there is some risk in it, and if it doesn't happen, then what? So my as an investor, if I say that my valuation of the startup is say 5 crore, and the startup founder says no, the valuation is 10 crores, then in that case we might agree that as investor I will put in money at say 5 crore or 6 crore valuation, but we may define certain milestones that if you meet this milestone, then I will convert it at 10 crore valuation, because then it gives me the guarantee that the startup is going to progress further. So it is called as a conversion trigger, or what are the conversion terms. So the conversion terms can be different. One can be based on the milestone. Another can be based on what is the valuation at which you will raise funds in the next round. So most of the times the conversion is linked to the next round. So when it is linked to the next round, what it means is when next time when you are raising funds, if you raise funds at say 15 crore valuation, I can say that that means your startup is valued at a high valuation. So I may say that I will convert at that point of time. Since I might take some discount, it is one more concept like if you are raising the next round at 15 crore, then I may convert my money at 12 crore. That there could be a percentage of discount that I may be expecting because I put in money at an early stage. The next investor is coming at a later stage. So that is what the conversion is all about. So you have to think about it in terms of if the startup owner is very confident that the startup is really going to grow very faster and very fast, and you are going to raise next round at a much higher valuation, then most of the times the investment is expected in convertible instrument, which can be CCPS or it can even be CCDs. But most of the times, the first investment which happens in equity.
Thank you so much, ma'am.
Any other questions?
So for this, actually, I can show that Excel because I thought it will take time. That's why I did not. That Excel which we were showing. So I can explain in terms of conversion how it happens. The second sheet, yeah, this sheet, this. So I just showed this first sheet earlier, which is about the equity funding, where the investor had invested 50 lakhs and they got 10% in the startup. So now, if this investment was in a convertible instrument, then immediately they wouldn't have got any equity. Then in that case, the investor would be a CCPS investor or a CCD investor, but the shareholding, which is the ownership of the company, will not change. Now, if the startup goes to the next investor, that is a new investor, and the new investor is now ready to invest, say, 1 crore in this company, at that time, the old investor who has put in 50 lakhs will also get equity. That is the point when his preference shares or debentures will get converted into equity. So at that time, whatever the valuation the new investor has agreed, that will be considered for converting the earlier investor's money as well. So right now, what I'm considering is if the start valuation that the new investor agrees is this 9 crore, here I have mentioned here as 9 crore, then then the value of the share is going to be 9,000 per share. In that case, both the investors, the old investor and the new investor, will get, say, old investor will get 555 shares for 50 lakhs, and the new investor will get 1,111 shares for his 1 crore. And then the shareholding will be like this, where the new investor will be holding 9.5%, the old investor will be holding 4.76%, and then the founders will dilute. When they reduce from 50 to 42, it's called dilution. So that is how they have diluted it to this equity. Now, if the old investor comes to you and they say that because I had given money earlier, I need more shares. So they may ask you to give them more equity. In that case, the valuation for them will not be 9 crore. It can be different. So if there is a 10% discount, then they will get some more shares. So how it is calculated is also, I have just tried to show it here. I'm not sure how much will it be, you will be able to understand when I am explaining it to you online, but I'll try my best. So if this second investment is happening in year 3, and if as per our agreement, year 1 was 10% discount, year 2 is 20% discount, and year 3 is 30% discount. So in that case, what happens is I will discount the current price of shares by this percentage. That means 9,000 is discounted by 30%. That means it is 6,300. So for the old investor, the share price will be 6,300, and for the new investor, it will be 9,000. So for the new investor, considering 9,000 as a share price, he will get 1,111 shares. But for the old investor, considering 6,300 shares, he will now get 793 shares. So here I have assumed it as 555, but we can assume it as 7693. Yeah. So if you put it at 793, his percentage increased. So that's how it happens. So the older investor will always want at a discounted price, depending on how long he has been in the company. So that's how the conversion happens. So I wanted to show this, but I thought if I didn't have time, then I won't get back. Yeah. So I think I'm done.
Any more questions? Please type it in the chat box, or you can raise your hand and we can take it.
Yeah, so this is a standard decided by Venture Center, ma'am. I mean, 4.5 valuation at 50 lakh. Or throughout India, all the government incubation centers, they have decided upon this. So what is that, ma'am? So
no, nobody actually. I mean, even Venture Center doesn't have it as a standard, or even it's not decided as a standard. It changes from startup to startup and stage based on the stage, because startup valuation is a product of many things, like the stage of the startup, the team that you have built in, the product which you are going to sell, the market for the product. So after looking at all that, the valuation is decided.
yeah, thank you.
Yeah.
Are there any more questions? Okay, so there is a feedback link in the chat box. So please give your feedback. It will help us to schedule our further sessions. Our next session is going to be on 19th of December, understanding how CCDs work. So
I think we have covered it today. So let's
Okay.
say we can do that.
Yeah, so we'll keep you all updated on this. So, thank you,
Yeah.
everyone.